Well, hi there, everyone, and welcome to the VIP Trade Room with Roger Scott and Matt Horton. Now, today is Tuesday, February 24th, and my name is Raleigh White, and I'm coming to you live from a really nice day here in Austin, Texas, and I'm going to be your moderator today. Now, in today's session, Roger's going to be covering a range of important topics with a continued focus on options and how to trade them. He's going to begin today's session by giving us a midday market analysis and what his updated large cap watch list is. And then we're going to pivot, folks, and we're going to start talking more about options and begin with the difference between debit and credit spreads. He's going to talk about what market structure we need to see when considering a spread. He's talking also about why premium is better than debit in choppy markets like the ones we're currently seeing, and how to put together and manage a credit spread. And when it comes to profits, do we take them early or do we like to wait for expiration when looking at credit spreads? Now, if you've got any questions during Roger's presentation, please type them in the chat window and we'll address them periodically throughout the session so as to not interfere with Roger's presentation. And also remember, folks, that I've opened the chat room to everyone, and we do have some ground rules. Always be kind and supportive in your posts, okay? Please keep on topic. No political discussions allowed whatsoever, and keep that chit chat between one or two of you to a minimum, because this is not a chat room, folks. This is a place where we have come to learn from the education and the information that Roger is going to be sharing, because after all, he's here to give us an edge in the markets and to help us all become much more confident and consistent in our trading activities. Now, for those of you that were with us this morning at 8 o'clock for Roger's pre-market briefing, we'll note that there were several catalysts on tap that we needed to be aware of. On the tech front, we noted that Keys was up 16% coming into the open, and Qualcomm was up 2%. On the retail and consumer front, we noted that Home Depot was up 3%, and we noted that Keurig Dr. Pepper was scheduled to go ahead and release their earnings before market opened. On the finance and on the business front, we saw that American Tower and Fidelity National were getting ready to release their earnings before market open. On the energy and the transportation front, we noted that Constellation Energy and NRG Energy and Expedia Tours International were getting ready to release their earnings before market open. On the international front, we noted that the Shanghai markets were open for the first time since a week because of the lunar holidays there in China. And we also noted that the Nikkei, that's a typo, folks, both of them were up 1%, not 15%. My bad, typo there. So the Shanghai and the Nikkei markets were both up near 1%, giving us some tailwind coming into today's market open. And then on the Fed front, we noted that we have consumer confidence data coming out. We had the Richmond Manufacturing Index data coming out. And then if you can believe it here, folks, we have 8 FOMC speakers talking today throughout the day. So that's what we have on the Fed front. Now, for those of you that are wondering why do we focus on these catalysts and why are they important? Well, from Roger's perspective, once again, if there's information that's going to be known, that's either known or will become known during today's trading session, well, those have the possibility of impacting the market, and we consider those to be volatility flashpoints. And so from that standpoint, we need to be prepared and ready for what that information might be and what the market response will be as well. As far as today's Rogers pre-market stock watch list is concerned, he's given us 24 tickers to consider today. On the short side, there were 11 tickers, and on the long side, there were 13 tickers. Now, where you see the asterisks here, like on BIIB, that means that that was looking like a very nice A-line setup. And you'll note that there's an underscore with Iron Mountain and on Merck and ADI and Rost, okay? And the reason why those are underlined is because when Roger was talking about them, he said, I really like these stocks, okay? So I wanted to call them out. Now, these stocks, and here's what you need to know. These are all legitimate stocks that are on Roger's watch list. They're on a watch list. Doesn't mean that you automatically should take these trades, but they are setting up as potential trades that Roger might take. And if he decides to take any one of these stocks on his short or his long list, more than likely he will post that in his trading pit channel or in his other premium alert services. Now, as far as Roger's pre-market comments were concerned, we noted that the futures markets were sort of up randomly coming into the open and being led by tech stocks, the NQ sector. We also noted that the put call ratio was in balance and that the VIX was up and looking to consolidate above the 20 level. Now, Roger was a little concerned about that. He says, what I'd like to see is the VIX drop below the 20 level, but coming into the open, it was sitting right there. As far as the bonds, the SPY, the QQQ, the MAGs, and the IWM were concerned, they were all moving sideways and consolidating, just sitting there. But the star of the show was SMH, the chip sector, which was up really nicely. That was the star. Now, as far as sector rotation is concerned, we see a continuing slow rotation towards more speculative stocks as they start to work themselves up the list. The big concern for Roger today, however, is when he took a look at the financials. That sector was basically showing only 29% of those companies below the 50-day average, were below the 50-day average, and less than 50 over the 200-day average. So money definitely moving out of the financial sector. And he's concerned about that. But he did point to the fact that he didn't see that the financial sector was going to be a huge negative weight on the market. It's much more of a standalone, but yet he was still concerned about that. So at the end of the day, he says, look, folks, let's keep an eye on the SPY and watch it at the 100-day moving average. That's a key level of support. He says if it stays above that level and moves higher, we could see some upside in the market. If it drops below that, we could see some downside in the market. And his other question was keep an eye on the financials. Money moving from the financials, where does it go? Is it going to go to cash or is it going to go to more speculative stocks? So these were his thoughts here in the pre-market before the market opened. And once again, getting ready for today, Roger decided that he wanted to spend a little bit more time talking about options. It's a very, very hot topic for a variety of reasons. And he's going to open today's session by giving us his midday market analysis and his updated watch list. And then he's going to pivot. We're going to be focusing on spreads and particularly credit spreads. So he's going to be talking about the difference between debit and credit spreads. He's going to be talking about what market structure is good and what do we need to see when we consider a spread. He's also going to talk about why generating premium is better than debit, especially in choppy markets like the ones that we're seeing now. And then he's going to show us how to put together and manage a credit spread. And once again, when it comes to profit taking, is this something that you look to do early, or might it be better to wait for expiration when looking at credit spreads and so much more? It's going to be a masterclass session on spreads and credit spreads. Now, if you have any questions during Roger's presentation, please type them in the chat window and we'll address them periodically throughout the session so as to not interfere with Roger's presentation. And remember, folks, that the chat is open to everyone and we do have some ground rules. Always be kind and supportive in your posts. Please keep to the topic. No political discussions allowed whatsoever, and keep your chit chat, sidebar conversations to a minimum, because all it does is interfere with the rest of us that are here because we want to learn from the education and information that Roger's going to be sharing. And once again, we know that he's here to give us an edge in the markets and to help us all become much more confident and consistent in our trading activities. And with that, folks, let's say hi to the team. Let's say hi to Matt there. Good morning. Good afternoon, Matt. How are you? Roger, always good to see you, my man.
Good morning. Or
Here we
actually,
are,
good afternoon.
Tuesday.
It's
Yeah, it is afternoon.
for you. It's you're in Central right now,
Yeah,
right?
I'm
Yeah.
in
So
Central Time, so it's 11 o'clock,
yeah,
Central Time.
it's a little
Uh,
confusing. It's a little.
I've gotten used to it. When you're working with a company that East Coast based, you just have to get used to the fact that everything is Eastern Standard Time.
You know, I,
Uh,
I was thinking, Raleigh, last night. I was thinking, this is just me thinking out loud. I'm thinking, gee, if I had a choice between different time zones, what time zone would I like? What would I pick? And I thought about it long and hard. And you know what I actually would be the best for me, not for everybody else. For me would be the best, the mountain time.
uh-huh.
Uh right in between the Pacific and the
The
Central.
Central. Mhm.
That would be the perfect time for me because I'm an early bird, but 6:30 is just too early. But I'm thinking 7:30 would be just perfect. But again, these are the things that go through my head at 10 o'clock at night while I'm watching TVs with my wife.
Yeah, well, I was raised on the East Coast, so I'm used to East Coast time, but I've lived here in Austin here, going on 25 years now. So I've gotten very used to Central Time, and I like it because things happen a little bit earlier. For example, if you like your late evening shows, when
Mm-hmm.
they come on, at 11 o'clock as opposed to 12 o'clock, it makes a difference. But
Mm-hmm.
anyway, it's great to see you, Roger. Interesting in the markets, always interesting in the markets. I know, in looking at your pre-market briefing and being part of that every morning, which is, by the way, fantastic, folks. You need to be with us every morning at 8 o'clock. But you were sizing up the markets, and you were basically saying, "Look, I'm really hoping that the SPY is going to stay above the 100-day moving average, because if it does, we could see a little bit of bounce in the music." What you were basically saying is, "I don't want to see it move below that." And then you also talked, at length about what was happening in the financial sector, from two points of view. Number one, the financial sector was selling off, but you didn't see that as a huge weight on the market. It's more like its own entity.
It's more of its own, not its own. Well, it is its own entity, just like any other sector. But I don't think there's two reasons. Okay, and this is really important for people to understand. Okay, there are multiple reasons why a sector could be cooling off. Okay, there's fundamental reasons why a sector could be cooling off. There could be bank regulations. There's a big difference between sector rotations and meltdowns. Okay, it's not the same. It's like when I do my scalp trades. Those are like, they're like they're. It's like um they're on a they got their own like agenda to get somewhere. Those trades I give you guys in the pit on high volume. Those trades are like they're on a race, against themselves. But sometimes we do slower trades, and it's the same thing with sectors. So it's always important to understand. And yes, I'm really big in saying the markets can't go much higher without financials contributing. That's because they have a big market cap. Think about Goldman Sachs, think about Morgan Stanley. It's like trying to rally without semiconductors. It doesn't go well, but it doesn't mean the market's going to crash.
Mhm.
We know the reason why financials are going down, and they're going down right now. Allegedly, this is from what I understand. They're going down right now because there's a concern about AI that the companies that are producing chips will have to spend more money to produce chips so they can make more powerful chips so that as a society we can grow. Okay, where I don't see the downside there. To me, it just sounds like a temporary issue where they have to kind of restructure how they think about the markets. But this is a good thing. That's a carrot. This is why SMH is at making all-time highs right now. This is not a bad thing. You have to differentiate between a credit crunch, which is, oh my God, banks are going out of business. You don't have liquidity. Your money may be at jeopardy. Get your money out of the bank. That's a credit crunch. That when financials go down because of a credit crunch, that's very, very significant. Okay. But when financials are going down, and we know the reason they're going down, and the reason really is ridiculous. I mean, it's silly. It's like, you know what it's like? It's like being penny wise and dollar foolish. It's kind of like, um, hey, let's spend $100 to organize a new company so that we could start making more money. No, I don't want to spend $100. It's too much money. That's kind of like what they're thinking right now. Like, oh, you mean you're upset because you see, I'm going to explain to you the bigger problem, folks, and this will tie everything together, okay, for you. And I think, Raleigh, this is an interesting conversation to have right now. Some sectors move up when you dangle a carrot for them, okay? Some sectors move up when you show them the hardcore cash, okay? Financials, the financials, they're definitely not a speculative sector. Why? Because everything is based on dollars and cents. They're the most mathematically priced in sector to the economy. Because anything that changes with financials, there's a dollar involved to it. There's a number involved to it. You can actually measure it. It's not like Nvidia. It's not like Elon Musk saying, "Ooh, we're going to come up with a new car in a year." Can you tell us more information? No, no, we haven't thought of it yet. We're just thinking, And the stock goes up, 20%. It's not like that with financials. Financials can't do that. Bank of America is not going to invent anything for you next year. You know what I'm saying? It is what it is. It's a very boring business model. But that boring business model also has Matt's cracking up, right?
Because if the banks start inventing new products, that's usually a recession indicator.
Exactly.
Yes.
It is.
Yep.
Yes, yes. And we're not saying that at all. We're not saying they're going to do that, that they're doing that. We're just saying that financials don't work like that. Okay, financials don't work like that. So it's really, really important. It's really, really really, really important for you to understand that this is not a market meltdown. There's nothing crashing. There's nothing burning. We now have more uncertainty with the tariffs, like we had beginning of the year. But hey, that's welcome to the next 3 years. That's how it's going to be. Well, actually, no, that's not true. Midterms. We'll see what happens with midterms. But anyways, the point is right now, financials are down, not because the market's bad, we're in a recession. Financials are bad because they have to update their business plan. Okay? Ooh, I'm okay with that. I could live with that. I could totally live with that. Okay? So you have to understand that this is a very healthy sector rotation. This is very normal. And I don't want you to start thinking, I'm really worried about the financials, because the financials are not going down for the right reason. You understand? They actually have to go down because there's something going on. And there's nothing going on right now, not even close. As a matter of fact, they were the first to report earnings, and their earnings were as solid as a rock.
Yeah, they were. Yep.
Yeah, so there's absolutely nothing to be fearful of. Okay, there's nothing to be fearful of, and I want you guys to understand that. Always ask yourself what is causing the financials to go down. Just because they're going down doesn't mean anything. Okay, you had a similar, by the way, you had a similar thing with utilities just recently. Do you remember when there was a lot of talk about how utility companies became nuclear companies? It was the same shtick. It was the same shtick. This is healthy. This is normal, and there's nothing wrong. And as you could see here by RSP, we're coming right off the 15. We're coming back up. The SPY is just hovering at the 100. And again, all-time highs are right here. And if MAGs can get it up, if they can get above this 15 and start going higher, we would be making all-time highs. And you know what the funny thing is? If the market was trending and making all-time highs, nobody would be even talking about the financials.
Right.
That would be the ironic thing of all. But yeah, always ask yourself why. So to get and I mean, it blows my mind away. They're concerned about AI. Okay, they're concerned about, well, I'm just curious. What did these banks think will happen in 20 years? Do you think that we're going to get rid of our cell phones and we're going to get rid of all our cars and we're going to get rid of technology? Folks, this is just the future of technology. You can't stop it. It's impossible. You can't put the genie back in the bottle. You can't put chips away. It's going to take a lot longer than people think it is. Okay. Your mailman is not going to stop coming to your door tomorrow. Okay. You're not going to, your a robot is not going to be walking your dog next Saturday. Take it easy. But in 10 years, they will. They will. They will. I mean, we're still having a problem with 4G in some areas. Okay. So let's not get ahead of ourselves. But it is the future. It is the future, and it's going to happen. And whether it happens now or 6 months from now, banks will have to adjust to this. And ultimately, this means more money for banks because the economy will expand based on all of this happening. All of this um, will make us economically more viable. Yes, the rich will get richer and the poor will get poorer. That will continue like it's always been. But ultimately, the whole thing is going to get better. And I don't see it any other way. Okay. And that's just basic economics 101. Okay. Enough of my rant, but I just wanted to make sure you guys are afraid because I got a couple of emails. Roger, the financials, the financials. We know why the financials are going down. It's ridiculous. AI valuations. I mean, wouldn't if that was a concern, wouldn't AI be the ones to be concerned about it? They don't seem to be having any problems with it. They'll figure out a way to get their money. Trust me. Okay. All right. All right. Let me give you stocks that I'm watching. I just had to get through that because
No,
people.
and I'm glad you did, Roger, because once again, I love it when you do your sector analysis in the morning and you started off by talking about NQ. You didn't like the fact that, that the NASDAQ stock, the NASDAQ 100 was at 49% off for 50 days. And pivoted and you said, and what's the worst performing? It's financials. And so, yeah, but you put it in perspective as well.
Yeah, yeah. Always, now. Here's the thing: if financials were going down and we didn't know why they were going down, and you started having bank stock, banks
Closures and runs on money and all that.
yeah,
Yeah.
yeah, yeah, yeah. That's all. Now that, my friends, is a hold or Trump, or Trump. Well, I don't know. Hey, you know what? I don't want to speak too early. I don't know what the hell he's going to say tonight. But like, as long as there's no conspiracy to like get rid of the Fed, you know what I mean? Like
Yeah.
stuff like that. Like this is just normal stuff that happens. So I just want to make sure you guys understand and don't let it don't start getting fearful of this market. We're nowhere there right now. Okay.
All right. So
All right.
what's on your watch list?
Let me show you my watch list. Let me show you my watch list. UNH. UNH, that's a bearish stock. Are you still long, Matt?
Yep.
Jeez. How much have you made today on the SPY?
We're up $4 before, and we're almost $2 into this trade.
We're up almost six handles today.
Yeah, as long as we close this trade.
That's beautiful. That, my friends, that's very, very nice. Very, very, very nice. I love that. By the way, Matt, can you tell everybody the last time we had a loser in True Trend? You guys are going to want to hear this. And we do trades every Monday in True Trend.
It was October of last year.
October of last year. October. What day, October?
We opened it on the 20th.
Okay. My last loser in the pit was October 13th of last year. All right. So I still got you beat by a week. All right. UNH, Humana. Some of the healthcare stocks are coming off. Notice they look exactly the same, and their correlation is probably 93%, if I had to guess. This will make a great gap to green, by the way, when it starts coming back up, because you got a high volume bar here. This will be nice. Anyways, I'm digressing. So you got Humana and UNH. By the way, notice they look almost identical. PLTR, Palantir, not healthy right now. Not a healthy stock. Below all the key averages, coming off. TME, 10 Cent Music Entertainment. I think this is a Chinese company. Please correct me if I'm wrong. Let me know. That's right, Cyrus. I'm going to go ahead and close the chat. Enough of the chat. Okay. Visa. Although, I'll be honest with you, it's a very choppy stock, and I'd really want to see it break this level. Because to me, it just looks like we're in to me, it looks like we were kind of in this channel right here, and then we just kind of bottoming out, and we're going to get back into it. It's just very choppy, that's all. Very choppy. Okay. Prudential, another financial stock. Okay. Healthcare and financial. Oops. Docs. Breaks down, consolidates, coming down again. Where have we seen this before? Do you remember the crypto chart I showed you this morning? Okay. Gaps down, tries to fill the gap, doesn't fill the gap, comes back down, comes back here. Whirlpool. High volume, breaking down on high volume bars, breaking the 100-day. The rest of the flag is already here. That's a nice breakdown right there. High volume here. That's a nice breakdown. That's a nice trade right there. The only thing I don't like is that it's a choppy stock, but that's a nice low high probability trade right there. High volume and breakdown. The only problem is you got a little support right here. So if it can break this area and close down here, that would be good. I would want to see this close near the low. Okay. Ryan. Downtrend is accelerating. Look at the slope here. Look at the slope here. Pulling back. High volume bars. Couldn't break out. High volume bar on the way down. Can't even bounce. Already broke the low. With a lot of high volume here. You see how I just gave you a story? And I mean, not just, a fiction story. Story based on this. Okay? All right. QTWO. Nice downtrend. Breakdown. Can't even begin to get it up. Nice high volume candles. High volume is coming to the downside. All of the high volume here came down to the downside. When we had low volume, we were just going sideways, you see. Low volume going sideways. High volume, we started going down. Still close to the 8-day EMA, coming down. Trupanion. We consolidate and we start building a new leg down. Look at the 5 minutes. This is a nice second. 1 second. Okay. That's a nice short right there. That's a very nice high probability short right there. Okay. I like this stock. I really like this stock. Let's see how liquid it is. It's not bad. You could work with this stock. See, notice I'm not looking at volume. I'm just looking at the spreads. Yeah, you could work with this stock. Okay. Let's look at the long side, shall we? FCX. Nice bounce off the VWAP. Oh, there's no volume here, though. So there's a lot of randomness here. Good for a swing, not good for intraday. Deck. Nice clean move right off the 8-day. GRNC. Oh, no, no. GNRC. Sorry about that. GNRC. Nice move. Nice move. And the volumes here was to the upside. Looks like it's just consolidating before going to the next move. Nice looking stock. Circle. Okay. VSAT, very choppy stock. Very choppy, but a nice move right off of the 8. Um, Walmart is at it again. Just needs to stay and get right up here above this area right there and stay here. That would be nice. BE. That's a very nice looking chart. The only problem is it doesn't have volume, but again, on a daily, it's not as relevant as intraday. Coca-Cola. Like Coca-Cola. I think Richie was talking about this stock the other day. Okay. Taiwan Semiconductor. What a beauty. I've been chasing this stock for the last couple of months. What a beauty. Again, the only problem is it doesn't have a lot of volume. But that's a nice high probability move. JCI. Very, very, very nice. Very, very nice move. Okay. All right. That is my watch list, and I am sticking to it. Now, do we have any questions before we move on to the next part of our presentation?
Nope, I think that pretty much covered it, Roger.
No questions? Wow, that's good. That's pretty good.
Just a lot of people very, and I'm going to be posting here for everybody, the watch list that Roger just put out there. So if you missed something, there you go. I just posted it there.
Nice. Very, very
And
nice.
there were a lot of comments about AI. We talked about AI, and I think the consensus was the future is coming, and we just have to learn how to deal with it.
Yeah, banks are concerned because the future's coming. What the? Like, what the? Really? Tell us more. I mean, okay. I mean, I'm sure roofers were very nervous when when people started building McMansions. I mean, that's just life. I mean, we get used to it. I mean, it's funny, Raleigh. I don't remember hearing that during COVID from them. We have to get used to a new environment. But AI, yes, they're going to have to. Yes, spend. These companies are going to be spent. The amount of money these companies. We're now. You know how we used to deal in millions, and then now we're dealing in billions.
In billions, I know.
Now we're gonna have to get. They're gonna have to start using the word trillions.
Trillions.
Yeah, I'm sorry if that's just too much for Bank of America. I don't know what to say. All right. Yeah, that word is very popular in Los Angeles, Sean, because people like to buy 5,000 square foot lots and build 10,000 square foot houses on it, which looks really
weird.
It looks silly. It looks silly, but that's what people have to do because they're running out of land, or they bought those houses for $200,000 30 years ago. Anyways, all right. So let's talk about options. So the first thing is, what is the difference between a credit spread and a debit spread? What is the difference? Can anybody tell me what the difference is? Okay. The difference between a credit spread and a debit spread is a credit spread is you are taking premium in when you start off the trade. A debit spread, you're taking premium, you're in the hope of making premium on the trade. So with a debit spread, you start out with a debit. With a credit spread, you automatically start out with a credit. So debit versus credit. Now, one of the cool things about credit spreads, okay, is when you take that credit, you know immediately what your downside will be, what your upside will be, and what you basically know your worst case scenario when you do a credit spread versus just buying an option. Okay. Well, in theory, with an option, when you buy an option, you also know your worst case scenario. But with a credit spread, you know the best case scenario and you know the worst case scenario. When you buy an option, you have no idea what your best case scenario will be. Okay. So that could be good and that could be bad, depending on whether you're a gambler or not, whether you like to speculate or not. And when I use the word gambler, I'm just, I'm just trying to make light of the situation. Okay. So why would we? So with a straight option, you can make an unlimited amount of money. Unlimited, theoretically, of course. Now, with a credit spread, you can't make more than what you originally get out. Okay. But here's the thing, you don't know what your odds of making that money when you buy the option. You see, that's the problem. When you put on a credit spread, you know your odds ahead of time. So if you feel uncomfortable with the unknown, a credit spread can ease that feeling because you will know ahead of time exactly what your maximum profit is, how much you're holding a trade for, what your maximum risk is, and all of that other good stuff. Now, here's an irony. I'm going to give you a little secret, okay? If you folks want time to start going by really, really slowly, like really, if you feel time in your life is going by really fast, and I'm not kidding when I'm saying this, if you feel time is going by really fast in your life, a credit spread will be your best friend because I have never seen time go by slower than when I'm in a credit spread and waiting for it to expire. Okay. Time stands still. So if you're complaining about not having enough, time is always running away. I wake up in the morning and it's time to go to bed, all that stuff, get into credit spreads. Murphy's Law never fails. Time will go. When I started doing credit spreads, I was like, oh my God, will these things ever expire? Back in the day, I used to do a lot of out of the money credit spreads, which is not a good idea. But anyways, so just so you know, time will stand still. Now, again, for some people, that's a great thing. For some people, that's it just depends on you. It depends on you. I discovered this when I was very young, and time wasn't going by that fast for me back then. Now, time goes by like this. I wake up, I take a shower, next thing you know, I'm coming home from work. So again, that's just one of the things that you will all notice. Now, well, Roger, if you get paid up front and you know your risk and all that stuff, then why wouldn't you always do credit spreads? Let me explain. Because sometimes a credit spread will give you less profit potential than taking a debit spread or taking just a straight option. Why? Well, because remember what I said, a credit spread, you get paid up front the max profit you will make. Now, it's not a bad thing. And in a market like we're in right now, it's a dream come true. I mean, Iron Condor's credit spreads, they're doing fantastic right now. I mean, the SPY's not going anywhere. But if the market's trending, a debit spread will be a much better friend for you than a credit spread. Whereas in a market that's choppy, that's directionless, that goes back and forth, a credit spread will be your best friend because you're not going to be able to accumulate gains on your debit because the market's not going anywhere. You'll make 20%, you lose 20%. You'll make 30%, you lose 20%. And then at the same time, you get time decay, which in a debit spread works against you. Okay. On a credit spread, time works on your side. Okay. Because time is decaying, and every minute time decays, that goes into your pocket. So instead of buying a piece of ice, you're selling a piece of ice. And how fast that time, how frozen that piece of ice is, you determine as well. You can buy something where by the time you hand it over to them and they put it in their pocket, it's already going to be halfway melted. Or you can give them a frozen steak where they could take it home and they could sit on it and wait another day before it even goes into the freezer. It'll be like a hard shoe. So again, that depends on you and the determination factor of whether it's a piece of ice that's leaking or frozen solid is how much time that option has till expiration. Okay, so you can control that. Okay, you can control that. Now, um, Okay. What would be the perfect circumstances to do a credit spread? Let me show you. When you're seeing this, okay, that's a good situation to do a credit spread. For example, when when you are not doing anything, okay? Because remember, we're not looking for the market to bounce far. We're looking for the market to keep doing exactly what it's doing. With a debit spread or a debit, we want the market to make a big move. With a credit, as long as it doesn't change its trajectory, we're okay. You understand? So we're not looking for a big move. Incidentally, you guys know how often the market stays choppy like this versus trending like this? 80% of the time, 75 to 80% of the time. On a debit spread, your profit is limited as well. But you you buy what you're paying and what you're getting in the end could be drastically different. In other words, you can buy a debit spread for $5 and sell it for 100 or 30, say 20. With a credit spread, you get the max up front. So that's what I'm saying the difference in the structure is, okay? Very very different, okay? Very, very different. So when would you want to do credit spreads? Let me show you. Markets coming near here. Very specific key levels, like the 15-day, 8-day. Um, let's see. Uh, Mags hitting the 200-day moving average. Because you see, with a credit spread, I'm not looking for mags to run away. I'm just looking for them to stay here. And the 200-day moving average holds really well. Remember I told you guys about 5 days ago that I'm expecting it to stay here at the 200? That's a very strong support level, and I'm expecting them to stay here. I said it to you guys right here about a week ago, maybe middle of last week. And they've held. So if you were to do a bull put spread here, that's how you take advantage of the long side. It's called the bull put spread. And to take advantage of the short side, it's called a bear call spread. Now, a bull call spread would be a debit spread, and a bear put spread would be a debit spread. But uh, a bear call spread is a credit spread, and a bull put spread is a credit spread. So again, to take advantage of the long side, you would do a bull put spread. To take advantage of the short side, you would take a bear call spread. Now, what if you do them together? What if you do a bull put spread here and a bull put spread here and a bear call spread here? That's called an iron condor. Okay? And that's how right now an iron condor on the SPY would have been actually really good considering the volatility is actually at 19 and a half. Now, how does volatility play into all of this? Folks, are you getting a little value out of this? Are you
Yeah,
getting
I think it's very, very eye-opening, Roger, because I think what you're doing is that you're dispelling a lot of myths and misunderstandings, which is really cool with what you're doing here. And people are looking, I mean, you're simply stating that if the stock or the market is moving chopping sideways, a credit spread makes sense. If you're looking
Yes.
at a trending market, a debit spread makes sense.
Yeah, and another time, I just want to add to what you just said. Also, when we're not just choppy, when we're bouncing off key levels. So,
Key levels, yep.
let me show you a picture so you'll understand what I'm saying. Let me just demonstrate this, okay? All right, good, 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 good. I'm trying to kind of teach you guys by getting you involved in the conversation versus just saying this is a call option, this is a put option. I don't want to be a dictionary. You can look up a dictionary yourself, you know. I want to actually try to give you some context. Um, okay, hypothetically. So let's say this is the 200-day moving average, this is the 100-day, and that's the 50-day, okay? And you got a stock that's moving here, okay? Just moving, and then it hits the 50-day moving average, okay? Now, if you know how I buy stocks, if you guys know how I buy stocks, You guys know I never buy a stock as it's going down against the trend. I don't anticipate, I don't do falling knives, right? I would wait for the stock to start consolidating here, right? And then make another, and then start going higher, right? Well, for a bull put spread, I wouldn't wait for all that. I would just maybe wait for 1 day for it to stay here. And that would be good enough for me. Okay. So I'm not looking for it to turn around and start going back up. I'm just looking for it to stabilize here, to stabilize here, to stabilize here. So if you see a stock, so here, let's say this is the 200-day line. So you see a stock that's moving like this, and then it just comes back and it just putzes around here. Well, I'm not going to even think about touching it for a long trade, but for a bull put spread, that's a perfect type of trade because all I needed is for it to stay above this line for the next 3 or 5 days, and I'm good to go. I can just take my premium and run because I'm going to be selling it a piece of ice that melts pretty quickly.
So,
Okay.
Roger, a lot of the questions that came up were around the terminology, which can be confusing. So, a bull put spread is a credit spread.
A bull put because okay, all right. Why is it called a bull put? Bull is bullish, and then I'm using the word put, right?
Yep.
Right? Okay. Bull put. Bull put is when you sell an expensive put and you buy a cheaper one. So you're taking advantage of puts in a bullish manner.
Okay.
Okay. A bear call spread is when we're selling an expensive call and hedging it with a cheaper call, buying a cheaper call. And we want the market in that environment. We want the market uh, to stay where it is or go down. So we're using calls to take advantage of a bearish move. You understand?
Hmm.
So that's why it sounds very contradictory. We're using puts and bulls at the same time, and then we're using bears and calls in the same sentence. You see what I'm saying?
Hmm.
So, because we're using puts to take advantage of the long side, and we're using calls to take advantage of the short side. Usually it's the opposite, right? You
Right.
buy a put to take advantage of the short side, you buy a call to take advantage of the long side. Here, we're selling an expensive put to take advantage of the long side, and we're selling an expensive call to take advantage of the call side. You understand?
And
So the
so,
trade,
folks, since we're selling here, once again, these are credit spreads we're talking about. These are the two types of credit spreads.
yeah, Jen, they cannot be a debit or a credit. If it's a debit, then it's a debit spread. It's a totally different animal. Okay. Ralph says, do we let it expire? I'm going to talk about that in a minute. I'll
Right.
talk about that in a minute. So what you're doing is you're selling something for $1 and you're buying something for 50 cents to hedge yourself in case all shit, all hell breaks loose.
Right.
That's really what you're doing. Are you still long, Matt?
Nope, I'm short.
Okay, be careful.
And folks, once you get, these are new terms for you, don't sweat it. You'll get used to them. You'll understand what they are.
By
I
the
mean,
way,
this is part of the language of the market, folks.
and
All right.
and, and speaking of and uh, that's funny. And speaking of the terminology, I have a perfectly good options boot camp with dozens of modules in the members area and in the VIP room that explain all this in fantastic details. Fantastic details. Now, so if so let's just review real quick. So let's say we have ticker symbol FCX, okay? And I think FCX is going to just stay up here or just go a little bit higher. Just kind of flag here, okay? Like I'm not expecting a big move at all. Oh, and I can get a good but I don't think it's going to come here below this area right here. I don't think it's going to come here. I'm pretty confident it's just going to stay here and build on the 8-day EMA. I could sell a bull put spread here and take in money. And as long as FCX doesn't go down to my level between now and my expiration date, I'm good to go. I'm good to go. So it's a way to take advantage of assets that are, instead of moving fast, I'm always, the stock is not moving, the stock is moving. I'm always looking for fast moving stocks. Well, this is to take advantage of things that are not moving as long as they don't move against us. Okay. Um, and folks, here's the beautiful part about all this stuff. Once you learn what a bull put spread is and bear call spread, remember, it doesn't change. This terminology, you only learn so much before you're like, oh, okay, I got it. I got it. I understand. You're trading calls to take advantage of a bearish move, and you're using puts to take advantage of a bullish move. That's all you're doing. Remember, you could sell these. You don't just buy them, you could sell them, right? You could sell them. So when you buy a put, you make money as the stock goes down. But what happens to the put seller? He's losing money, right? So a put seller will make money when the stock goes up. And a call seller will make money when a stock goes down, just like a call buyer makes money when a stock goes up. All right. And again, there's a finite amount of situations here. You don't have indefinite amount of scenarios. So, and what happens when you take a bull put spread and a bear call spread? It's an iron condor. The combination of the two is just an iron condor. So it's really, 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 really simple. All right. Really, really simple. All right. I'm going to close the chat. I don't want to get in trouble. All right. Okay. So the next question is, well, Roger, okay, now we kind of understand the general conceptual idea behind it. But what about, do me a favor, Matt, can you open my door?
Mhm.
It's hotter than heck in here. Thank you. Matt and I have two offices that they took the wall off, and we have two doors. He has a door and I have a door, and the doors are next to each other. So he uses his door and I use my door, and we walk in and we're like, hey, hello. It's kind of funny. I guess you have to be here, but it's kind of funny. All right. So now this is the part I want you guys to pay attention to, and I'm going to spend about an hour explaining this to you in the next section of our class here. But this is what I want to explain to you. When you do, so let me show you something, okay? So I'm going to use a ticker symbol that a lot of traders love to do these trades on, okay? AVGO. So let's say that I think that AVGO is going to go up, okay? I would go bull to the puts, right? And okay, let's say that I do not think that we're going to break 300, okay? So this is how most option sellers do it. Professional option sellers do it. They'll go about, say, I don't know, 10 days out. They'll go down to 300. Okay. And they'll say, okay, 10 days out, 300, let's say 302 versus 305, okay? 40 cents. 40 cents. So they're going to take in 40 cents of premium, and their risk is going to be $2.50. So they're going to take less than a fifth of their risk per trade. Now, why would they do that? Why would they take such a small credit? Why would they only take 40 cents for every $2? If you can make 40 cents and you can lose $2.50, most of you would say, yeah, I don't really want to do that. But that's how most income traders trade. And I'll tell you why. Because the odds are the stock is not going to get here within the next 10 days. So their odds of making that money are pretty good. It's about 95%. But this is the problem. Okay. The problem is, and trust me, I've seen it before. What you end up doing is you end up walking into a program that's called walking up the stairs and falling down. You're going to make money 19 times. And the 20th time, you're going to give back everything you lost the preceding 19 times. I've been there before, and it actually happens exactly around the 20th trade. Right when you start getting really confident and adding a bigger position size, for insult to injury, right? Because Murphy's Law never fails when it comes to trading, right? We know that. Okay. So let me continue this. This is going to get good. So what happens is you take your 40 cents, you take your 40 cents, you take your 1 second. My wife from Tampa. Okay. All right. Sorry about that. That was my wife. Happy wife, happy life, happy wife. Okay. All right. My daughter's getting ready to go to law school, and she's freaking out about acceptance, and she's not eating that much, so she's losing weight. So my wife decided to go to Tampa to babysit her and make sure she's okay. To make sure she feeds her for a few days. What a mom would do. Anyway, so she just called me to see how everything was going. Anyway, sorry about that. So we're doing really good here. So what a lot of option traders will do is they'll take very small premiums, and the risk is very, very low on the trade, and they're happy with it. The problem is they end up giving it back. I mean, there's an actual name for it: walking up the stairs and falling down. I did not make this name up. Okay. But so when I started my program, I started trading it the same way. I started taking in about, let's say, 10 cents for my average was about 6 or 7% on the trade. Okay. That's what I was taking, 6 or 7% on the trade. So to give you an example, the risk was $1. I would take in like 8 cents. That's really, I don't want to lie to you. That's really what it came down to. And people were happy. Everybody was happy because they were making money.
Yeah, high win
But
rate.
I
Yep.
knew, but I knew, I knew, I knew. I started getting, I was actually getting a lot more nervous than a lot of my students were, because I knew that that one time would come, and you can't escape from numbers. And one day, believe it or not, you might remember this. This was about 2 years ago. This is when AMD. Um, this is the first time in history, since AI was, making new highs. This was the first time that we heard AI concerns. Okay, this was the first time. And again, it was like a year and a half, 2 years ago. It was the first time. Till then, AMD and Nvidia were just it just kept going straight up. And we had puts on AMD, and again, the spreads were $1, and we took in like 8, 9 cents, something like that. And the trade started going against us. And I had a day off that day. I wasn't working. I had a doctor's appointment. And one of our clients emailed me. He's like, "Hey, what do you think about this trade?" I'm like, "I think it's going to be okay, but I'm nervous about it." But I was thinking to myself, folks, this is a true story. I'm not hyping this up. And I thought to myself, if I'm getting this nervous about a trade, because the trade was already worth like 50 cents and we only took like 9. So we had a pretty big debit. And I said, you know what? I don't like this. I don't like this at all. I'm not going to do this anymore. So I went back into the office the next day, and I said, you know what? By the way, the trade worked out fine. The trade worked out great. We took money on that trade. But I said, you know what? I'm not doing this no more. I'm going to trade these credit spreads my way, the way I know how to trade. So what I started doing, and this is what you want to pay attention to, okay? So what I started doing was I started trading these credit spreads the way I trade everything else, looking for stocks like this, for example, and putting trending stocks that are moving. And I started doing credit spreads real close, like real close. Like the job of a credit trader is to go as far away from the sun. This is the sun, to fly as far away from the sun as possible. I said, you know what? I'm going to go as close to the sun as I can, because I think the stock is going to continue going higher. So I started doing spreads on trades like Walmart at pivot points, and the kind of trades, BE, Coca-Cola. This is actually a perfect example, okay? And 2 years later, guess what? Guess what I realized? So instead of taking 8 to 9% on a trade, I now take between 40 and 60% on the trade. Okay. Every time. As a matter of fact, if I can't get 40 to 60%, I will not do the trade. I will not do it. I'll just walk away from it. And I've done that every time. And more so, our win rate has been over 80%. So if you and our, remember, if we take it now, this is the part you want to pay attention to, okay? If you take in 40 to 60%, that means your risk is only going to be 40 to 60%, right? Right? Of if I'm taking it, so look, if there's a dollar and I take in 50 cents, that means there's another 50 cents of risk. Otherwise, I'm capping myself. So there's no more risk. So I'm always playing 50%, averaging 50%. So if I lose 50%, not 90%, not 180%, 50%. If I win, I make 50%. But my win rate has been over the last 2 years over 80%. So now do the math. Put that in your little expectancy formula. 50% win, 50% loss, over 80% win rate. So think about that. You win 8 out of 10 times, 50 cents or $5 or $50. And you lose $50 when you're wrong. You still keep the premium, okay? So you can't lose more than, and our win rate has been over 80%, and we do at least one trade every week. Not bad. So I went from being right 90, 95% and taking in 8% and doing this to taking 40 to 60% with an over 80% win rate. So if somebody told you, hey, Roger, we have a way for you to have an over 80% win rate, and when you win, you make the exact same amount as when you lose. But you're right 8 out of 10 times. That's a winning formula. And that, my friends, is what I'm going to be talking to you in our next segment. And I'll give you more details. Now, Raleigh, do we have any questions before we move on?
Yeah, let me go ahead and pull up my sheet here. Well, first of all, terrific presentation. Once again, I think you cleared up a lot of people's questions and misconceptions about the difference between credit and debit spread. And so let's see here. So some people were wondering on a credit spread, do you end up with the stock?
Oh, you mean if we get exercised? Well,
Yeah.
if if you do, you could just get rid of it. But that happens maybe once every. How many times have we been exercised? I think in the entire time we've been exercised twice. So you can always liquidate the spread before and not get exercised. So it's not really an issue. It'll happen by accident because you forgot to liquidate the position. But if you don't forget to liquidate the position, the only time you'll get exercised is if we hold trade all the way till expiration, till the end last day, and you're in the money. And then about 10, 11 o'clock, you get exercised. As long as you liquidate the position, you're fine. And if
Ah,
the and also, if you're in the money and your short gets exercised, you can exercise your long and they cancel each other out.
and they
And you still
cancel each other out.
and you
Yeah.
still keep the premium. So let me give you a realistic scenario here. And if this sounds complicated, it's not. It's just you got to get used to it. So for example, Coca-Cola is going up, okay? Here's puts, okay? Let's say that I think that Coca-Cola is going to continue going up, and I do at this trajectory, or just kind of stay right here and just kind of chop around over the next 10 days, okay? So let's go, see, where are we not going to go? 70, so 79 right here, okay? 79. 10 days to go, 10 days to go. And you have right here, you have, well, how about right here? 80, 81. Right here, 50 cents. What's your risk? $1. So let's say that Coca-Cola goes to 75. Hell, let's say Coca-Cola goes to 65. You're long, you're long the 80. I mean, excuse me, 81. You're short the 82. So what do you care? You just exercise one. This will be auto exercise. You exercise this. They'll take $1 from you and you still have 50 cents. Okay? Oh, not right here. Sorry, right here. And you still have your 50 cents. So you lose 50%. I'm telling you, just think about this. Imagine
Hmm.
someone told you you could you have we can hook you up with a trading system that has 50% winners, 50% losers, and an over 80% win rate. Matt, can you check the win rate on weekly cash flow real
Yep.
quick? That's pretty good, folks.
Yeah,
That's
it's
pretty.
right at 80% even, Roger.
That's what I thought.
72 winners, 18 losers, 80%.
80%. And again, so now that you understand the intricacies, I'm going to show you actual numbers and show
And
you some.
Roger, there was one last question,
Yes,
and
please, please.
I think it might tie into your recent explanation. But Dieter said, he said, Raleigh and Roger, I did a credit spread last week that would have expired well in the money. Why did my broker close one side of the trade 2 hours before expiration?
Because it was going to expire in the money and he didn't want you to exercise because you probably didn't have enough money in your account to hold the
Okay.
trade. That's what they'll do for you. Yeah. Yeah. But remember, you can also exercise the long side. So assuming it's in the money. If it's not in the money, then you could just go to the market, buy the shares and cancel each other out. That's it.
Yeah,
And you keep the premium.
exactly.
Yeah. I mean, look, in trading, anything will happen. Anything will happen. But how often does it happen? Maybe twice a year, once a year. Something will always happen. But again, these things were hedged. We don't have any naked exposure. You're only one, whatever you're short, you're only one strike away long.
Yeah.
You're kind of going with the party. So it's like, Roger, what if the stock gaps down 100 points the next day? Okay, you're one strike. You have a long position, one strike away. Take it easy, okay? No one's dying, okay? It's like the market went from 1,000 to 100. Yeah, but you bought the 190, the 999 call. I mean, put. So what do you care? I mean, you're right there. You're going along
Exactly.
with the ride. All
And
right.
the thing that I hope everybody understands here, what Roger is sharing with you is new tools that you need to have in your toolkit if you're going to be trading the markets. If you've only been trading the markets, buying calls and buying puts, well, it's time to upgrade your toolkit and take a look at what spreads can do for you and learn how to use those tools and then apply them. So, for those of you that are with us in YouTube channel, folks, it's time for you to come over to our Zoom room because we are going to be stopping the stream to YouTube here in just a few seconds. YouTube doesn't like it when we do any promotional events. They don't like it when we play music, things of that nature, and we respect that. But at this point in time, I'm going to be stopping the YouTube stream. So come on over to the Zoom room. If you're already here, that's great. There's nothing for you to do but to sit back because Roger's going to continue this discussion and talk about a very, very special program